Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRL Lay the Answer. And I want to take a few minutes and talk about where the stock market is likely to go from here. Now, I hope you know that if I knew that answer, then I'd be very, very rich, as would all of you. So we can't talk about exactly where it's going to go, but we can talk about a couple of key indicators that give us some clues to the stock market mystery, and we can find out, or at least get an idea as to where it may go from here. Now, this video is primarily for my clients. So if you're a client of mine, thank you for your trust, thank you for your business. You know I don't take it lightly. If you're not a client of mine and you have any conversation or any questions about anything we talk about or anything I discuss in this video, please don't hesitate to call me. And you can find our contact information on our website at providencefinancialinc.com. providencefinancialinc.com. So the market's been very volatile. I don't think that's a secret to anybody, especially if you have money in the market. The market's officially down 10% at this point from its all-time high. And that puts us in official recession territory. Now, there's been several times in the last few years that the market's gone down 10 or 12%, only to bounce back. Now, in the previous times that this happened, they've always bounced back. The market has always recovered very quickly within just a matter of a few weeks. Well, now the market's been having problems for a couple of months, and a lot of you are asking me, what should we do? Should we cash out? Should we wait to try to get it back? I do know a number of you are waiting to try to get that, that money back, that kind of ink out that last little bit. And we have a number of people who have told us that once they get it back, then they're going to get out of the market. And the question that I have to ask is does that make sense? Even the professionals don't try to time the market to the top and to the exact top and the exact bottom. You really can't do that. They play a game that's called top 10, bottom 10. They try to get out of the market in the top 10%, and they try to buy in the bottom 10%. And we're still in that top 10%. And the question is, are we going to go up in that top 10%, or are we going to go down in that 10%? But I believe that we're in that top 10%, and there's no shame in taking your chips off the table. If you sit down at a Las Vegas casino and you hit the jackpot, most people sit there and stay and put it all back, and that's what the casino wants you to do. If you want to, if you win $100 and you want to sit back and put in another $10 and you realize, okay, you didn't hit it again, you didn't get ultra lucky, just lucky the first time, there's nothing wrong with walking away with $90. That you already have won the game. You just didn't walk away with the full winnings. It's very difficult whether you're in a true casino like Las Vegas or whether you're in the Wall Street casino in the stock market. It's very difficult to walk away at the exact top. So let's take a look at a couple of key indicators to see where the market may go from here. And there's two indicators I want to look at. I want to talk about the yield curve, and I want to talk about the price to earnings ratio, the PE ratio. And I'm guessing that most of you watching this have heard of both of those, but may not quite understand the magnitude of how predictable or how much they can predict where the market is likely to go from here. So let's take those and let's talk about the yield curve. Well, what is the yield curve? Well, the yield curve is very simple. It's a measure of how much interest you're going to earn over a period of time. And specifically, we're talking about Treasury bonds like the 10-year Treasury or the 20 or 30-year Treasury. So the reality is that the longer you go out, the more interest you want to earn, right? So if you think about a CD, if you bought a 2-year CD or 10-year CD, which of those CDs is going to pay you more interest? Well, the 10-year CD, because you're committing to a longer period of time. So the longer you go out, the steeper the curve. So a yield curve looks like this, or I should say a healthy yield curve looks like this. You graph it out on a sheet of paper. The longer out you go, the greater the amount of interest you're going to earn. And so one of the key metrics that is looked at by bondholders is what is the risk premium, or what is the difference of, what is the spread, the difference of how much I'm going to make if I commit my money for 10 years versus if I commit it for 2 years. Because if that difference is great enough, if the reward is great enough, then you're willing to commit your money for a longer period of time. And if you go back, and I took some notes, so forgive me for looking, but if you go back to 5 years ago, okay, January of 2014, that spread between the 2-year Treasury and the 10-year Treasury, which is very commonly looked at, that spread was 2.6%. That means that if you committed your money for 10 years, you would get 2.6% interest more per year every year for 10 years. And that's where it was. And that was normal for that time. But from January to 2014 to now, that curve has come down. And that spread has gotten narrower and narrower and narrower. So the spread today is 0.16%. 0.16. That means that if you committed your money for 10 years and you bought a 10-year Treasury bond, that you would earn 0.16% more than if you bought a 2-year Treasury bond. So for 0.16% more, you're willing to commit your money for another 8 years. That's what that means. Does that sound like it makes a lot of sense to commit your money for another 8 years for only 0.16%, about 1/8%? Does that sound like it makes sense? You're probably thinking, no, why would I do that? Here's why people are doing that. Okay? And they are doing it. That's what the spread is. Here's why people are doing it. People are doing it. Institutions are doing it because they think the stock market's going to have problems ahead. And when the stock market has problems ahead, there's a certain group of people that are going to sit on the sidelines and they're going to wait for a better time and get back in the market. But there are a certain group of people, like maybe the baby boomers, that happen to be controlling the economy at this point, as they have been for the last couple of decades. There's a baby boomers that are going to be done with the market. They're later in life. They can't afford to take the risk anymore. They're not going to take their money and set it on the sidelines. They're going to buy safer investments like bonds, like Treasury bonds. So when the market starts to have problems, as it has had already, then they're going to buy bonds, and so the demand for bonds goes up. And as the demand for bond goes up, the yield goes down. The yield goes down. So they're willing to pay more for bonds because they want to lock in a higher rate for a longer period of time. And the only reason that you would commit to a 10-year Treasury bond at 2.9% or so, which is about where it is today, for 0.16 more than you could commit your money for 2-year, there's only one reason you do that. And that is because you think in years to come, that yield's going to go even lower. So you want to lock it in. And the only reason that yields are going to go lower is bond prices become in demand. People buy bonds, it sends a yield lower, and bonds will only generally come in demand if the stock market starts to have some major problems ahead. And the fact that the yield spread is so thin, 0.16, is representative of what you might have been hearing them talk about, of a flat yield curve. A healthy yield curve is supposed to go like this, but a flat yield curve is like this. It's not healthy. And I'll tell you, just a few days ago, it was not 0.16, it was 0.10. So people were willing to commit to 10 years for 0.1% more because they think it's the best they're going to get for the next 10 years. That's scary. Now, one day last week, I heard CNBC report that the yield curve had inverted. That means that for a split moment there, that means that people were willing to buy 10-year bonds at an interest rate that was actually a little bit lower than what they could get a 2-year bond for. Why? Because they think there's going to be some problems ahead. So it's a very telling sign that the market's probably got some trouble. Yield curve. Let's talk about the standard, not Standard & Poor's. Let's talk about the price to earnings ratio. Okay, what I meant to say. Price to earnings ratio. Well, you might have heard of it, PE ratio. And what's the significance or what's the importance of the PE ratio? Well, let's talk about what the PE ratio is first, because you've probably heard the term, but most people don't really know what it is. Well, what it is it's a measure of how expensive the market is. That's what the price to earnings ratio is. How expensive is the market? And every stock has a PE ratio, and that means that the market as a whole has a price to earnings ratio. But you take the price, you divide it by the earnings, and that ratio is going to give you an idea as to how expensive the market is. let's take an example, kind of a silly example that I think may bring this home and make it easier to understand. Let's say that I own a business. I don't care, donut shop, let's say, okay? And you and I are friends, and you know that I make $100,000 a year in my donut shop. And I come to you one day and I say, hey, I don't know what to do. And I got this check. Someone came into my donut shop today. He wants to buy my donut shop, and he gave me this check. And I give you the check, and it's a check for $2 million. Let me ask you, what would you tell me to do? I've asked this question a lot in explaining price to earnings ratios, and I got to tell you, never has anyone said keep the donut shop. I've heard people say things like, well, if you could take that $2 million and earn 5% on it, you can still get $100,000 a year, and you don't have to show up for work every day. Absolutely. Most people tell me, absolutely sell it. Matter of fact, run to the bank to make sure that that check is still good before he changes his mind. Because $2 million for a business that pays $100,000 a year is very expensive. But if you take that $2 million and you divide it by $100,000, you come up with the number 20. And that 20 is the price to earnings ratio for that business. So price to earnings ratio of 20 is fairly expensive, okay? Now the nice thing about a price to earnings ratio is really, it doesn't matter whether you have a $2 million price divided by $100,000 or whether you have a $2 billion price divided by $100 million. Once you chop off all the zeros, 20 is 20. So the price to earnings ratio at 20 is expensive. So then we have to ask ourselves, well, where's the price to earnings ratio today? Well, the price to earnings ratio today is 20. It's actually exactly 20. Whether you're looking at the S&P 500 or the Dow Jones, it's 20. And yet the market's down 10% from its previous high. Prior to this 10% decline, the market was closer to 22. The S&P 500, or rather the price to earnings ratio, was closer to 22. So 10% decline caused it to come down a couple points. Now, you'd be interested to know that the average price to earnings ratio is around 15. So really, when you hear them say that the market's overpriced, it's overbought, that's what they're talking about. In order to be normalized, in order for the price to be normal, price to earnings ratios have to be around 15 or so. That's the average long-term price to earnings ratio. So 20 is expensive. And really, in order for stock prices to get in line with what's normal, stock prices across the board have to come down about 25%. If the price to earnings ratio is 25% too high, it's got to come down about 25% in order for the stock market to be more reasonably priced, not overpriced. Now keep in mind that there's nothing magical about that 15 number except that it's a long-term average. But an average can be misleading. An average means that sometimes the price to earnings ratio is higher and sometimes the price to earnings ratio is lower. So it doesn't mean that if the stock market or the price to earnings ratio goes from 20 to 15 that it stops there. What if it goes from 20 to 10? What if it makes this shift from 20 to 10? Well, in order to get from 20 to 15, it's got to go down 25%. That puts us at a Dow at about $18,000, whereas today, the Dow's at just over $24,000. That's essentially where it could go. And do I think it's possible? I think the yield curve is telling us it's possible. I think the fact that stocks are overpriced, I think is telling us it's possible. And just the fact that we're in the longest bull market this country has ever seen, I think you put all that together and it tells us that it's possible. Nothing goes up forever. And the concerns that we have today in the economy are the immediate concerns that could start the landslide as if the negotiations with China and some of these other countries starts to fail. I think that could be a kind of the snowball that maybe leads to the avalanche. And the reality is that but the longer term effect is that just the fact that the global growth is slowing, and that's the primary concern the market has. So what does that mean to you? Well, if you're a client of mine, it doesn't mean a whole lot. You know, your clients and your money's invested for income. You're getting that consistent income consistently and persistently, regardless of what the market does. If you're not a client of mine and you've got a lot of money in the market, I'm just going to suggest that you don't have to write it out. You don't have to feel like I got to get that 10% back. I got to get back to where I was. That could be a dangerous game to play. And if you're looking to retire in the next, 3 to 6, 9 years or so, really in the next decade, it could be very dangerous. A lot of people have decided that they want to just sit on the sidelines. They've cashed out at this point. They're just waiting for a better time, or they've started investing for interest and dividends for income. And a lot of people that don't know what to do, and that's where a lot of people are, a lot of them have taken half their chips off the table. Cash out with some of it, leave the other half of it. Then in that way, if the market goes down, you'll be glad you got half out. You can always get back in later. And if the market goes back up, you'll be glad that you left half in the market. That's what a lot of people are doing. So just wanted to give you those thoughts. I can't tell you what direction the market's going to go. Wanted to give you food for that. If you'd like to discuss this further, don't hesitate to call my office. Again, if you're a client of mine and you're a little concerned, feel free. You're always welcome to set up a review with me as much as you want. And you should have our numbers, or you can get that through our website, providencefinancialinc.com. Well, thank you for watching. I hope this market update has helped. I'm Anthony Saccaro, founder and president of Providence Financial and Insurance Services. Thank you, and God bless.